Hi, I'm Keith Cottrell, the creator of the Trading Edge strategy, which goes all the way back to 1994. And in this video, I want to discuss some of the principles that I discovered, found out, and were shown by some really good traders of their day in the 1950s about how to detect a market top and why I believe currently we're seeing this actually unfold. Now, this video isn't scripted. It could meander a bit and whatever, but the point here is to get across to you how important the findings are and also the points I obviously want to get across. So do excuse if it rambles a bit. The point is it's time sensitive. We're a week away from inauguration of President-elect Trump, and I just want to get this out. So I'm going to split this video into three parts, and the first part is the fundamentals behind why I believe this is the case. Then we're going to look at the stock market, and I'm going to reveal something to you you will never find in any spread betting online chart service or whatever. This is hard data, hard facts, end of day data that I've used since 1994 and continue to use to this day, the bigger picture of what's going on. I'm going to show you why I believe the banks and the major corporations are actually selling in anticipation of Trump's inauguration. And then finally, I'm going to throw this into the mix as well, implied volatility. Now, if you're watching this and you know nothing about it, it's basically a measurement of risk in the market. And I'll describe the relationship and also show you the charts which I have created myself to convey how important this is and how well it's worked in the past, to the point of being incredibly accurate as well. So first, let's look at the fundamentals behind why I believe that we're on the cusp of something major here as far as the financial markets are concerned. So the first thing, fundamentals. What's going on in the background that would add to the fact that we're possibly at the top of the financial markets, or certainly are going to see a major correction, if not a crash? Then we're certainly going to see a major pullback. Now, we know the establishment and the elite can't stand Trump. That's self-evident with all of the propaganda that's being put out. They're trying to smear him or whatever. I don't take any notice of the political side of things. I'm more interested in the economic side. But it's plain to see. And even Obama yesterday has issued this statement that he's going to remove the National Guard chief on the day of Trump's inauguration. This is a first, and it's going to take place at midday, just before Trump is going to be inaugurated. Now, I'm not a conspiracy theorist. I'm not saying he's going to be assassinated on the day. What we're looking at here is the background of what's going on to make life difficult for Trump. So why wouldn't they crash the market on him? I mean, that is the real deal for the elite. And I'll show you why I believe they've exited as well, or in the process of doing so, as we go through the video. And you can see here, confirmed unknown Republican, Democrat paid for anti-Trump. And then as you just go through, you can see there's far more scandal. They've got here bipartisan Senate Intelligence Committee to probe Russia on campaign contacts. Trump enemies see an opening. YouTube, the fake news crusade shuts down popular conservative channel. You can just see that it just keeps stacking up. And then we've got here, Dow 20K disappoints for fourth straight month as banks pump and dump. That's an interesting article. So let's see how the fundamentals unfold. The primary issue with this video really is to actually look at the fundamentals. So we're going to move on to part two, but you get the gist. I could find thousands of articles about this, but the main thrust here is that the establishment and the elite can't stand Trump. In part two, we're going to be looking at the stock market, and we're going to be looking at a certain phase that occurs in the stock market that not many people are aware of. And this phase is called the distribution phase. And as the name implies, it is when the banks, the market makers, and all of the big shots in the market will be offloading their stocks, their shares, hence the name distribution. So they'll be distributing the stocks to the weaker holders. Now, many years ago, I was introduced to a veteran trader by the name of Tom Williams, who worked out in California. And he, in the days, 1950s, they actually plotted everything by hand on graphs. So they got a feel for the market they were trading, and they understood the volume as well. And as he says here, at a potential top of a bull market, many professional traders will be looking to sell stock bought at lower levels to take profits. Most of these traders will place large orders to sell, not at the current price available, but a specified price range. Any selling has to be absorbed by the market makers, who have to create a market. Some sell orders will be filled immediately, some go figuratively onto the books. The market makers in turn have to resell, which has to be accomplished without putting the price down against their own or others' traders selling. This process is known as distribution and will normally take some time. In the early stages of distribution, if the selling is so great that prices are forced down, the selling stops and the price is then supported, which gives the market maker or the traders a chance to sell more stock on the next wave up. Once the professionals have sold most of their holdings, a bear market starts. So there's some interesting points in here. First, we've got obviously they're going to start selling, and the selling has to be absorbed, otherwise the market's going to just fall out of bed and move to the downside. We can also see that some sell orders will be filled immediately, and some will go onto the books as well. This is another important point as well. The process is known as distribution and will normally take some time, and time is the essence of this, which we're going to come on to in a minute when we look at the price chart. And in the early stages of distribution, the selling can be forced down and brought back, which we've just seen as well. What's interesting are these certain points to look at. We've got the sideways move, the trading range, and the increase in volume. They're the three most important parts in this. So let's move on to the price chart. This is the Dow Jones 30. And we've got, this is a daily chart, so every price bar represents 1 day's worth of trading. Now, if I just drag this chart over here, you can see the volume is pretty negligible. You get the odd day with a spike, but there's not a lot going on. As I move the chart back over to the left, you can see all of a sudden we've had this massive increase in volume. We have the trading range and we have prices being brought back up each day. To throw into the mix as well, we also have in the Dow Jones a record high. That record high is the 20,000 target. The market still hasn't reached this, and for those of you that follow me on a daily basis, you'll know the reasons behind why I believe we're not at the 20,000. This video is about this at the bottom, the massive increase in volume and the market trading sideways. What we're seeing here is exactly what Tom described in a distribution phase, where we're seeing the pros bring the market up. You can see that they ran the market up there. This is the first part here. Let me just pop on this this crosshair. You can see there we've had Trump elected over here November the 8th, and the market's run up, and then all of a sudden they're running the market up and selling into the rally. Now on this day, which I believe is December the 16th, you see this massive increase in volume, and from this point on the market moves through Christmas to the upside. We've got a bit of a drop off in volume as we go through the Christmas period, and then we've had this sideways motion of prices, again trading range with the increase in volume, and it's massive compared to what we've had any other time in the chart. Now, to see this more clearly, I'm going to switch this to a weekly chart, and now you'll really start to see what's going on here. You've got this massive increase in volume. Let me just spread the bars out, and now you get a clearer picture of what's going on. And if you don't have end of day price charts and also the knowledge of knowing how distribution takes place, you're not going to see this. You're not going to actually spot it. The weekly chart gives the best view. You've got a market that's range bound. You can see that there. You've got all of the characteristics: volume increasing, market trading sideways. Now this makes no sense, does it? Let's just work on some simple logic and common sense here. When a market moves higher, the volume should increase to show the buying, and vice versa on the downside. So how is it you can have what we've got here, 1, 2, 3, 4, 5 weeks of the market stuck in a range, and yet the volume is the largest it's been since 2009? So you've got a situation here where there is a huge amount of trading activity, and yet it's not reflected in an increase in the price. And it can only mean one thing, and that is that the pros are offloading their stocks. And again, you then overlay the background with Trump everything else. They don't like him, and if you ever wanted a fall guy or to get out of the market, then here's the picture that you've got. I've not seen this since 1994. It's been a long time coming, 23 years. And in the monthly chart, you're probably thinking, well, there's not a lot there. We just got this one big spike. It's true, we do. But what you've got to do is to go back to 2009. That was the last big spike where we had the start of the rise in the stock market. When they bought into the market, we started with the 4 trillion of printing money in the US, billions in the UK, billions in Europe, and that was the start of this phase. And you can see that the market, there was a bit of buying initially, and then the market started going up on fresh air. And again, in another video, that the debt video that I recorded on the channel, you can see the correlation between printing money and the stock market going up. But what's interesting here is this big spike is the first time for a very long time, well, where are we, 2017, 8 years, that the market has actually shown some major move. But there's also something, not major move, sorry, major volume. And what's also important in this is if you look at this bar here, we've got low volume. The price range is quite, it's moved nicely all the way through November. This is when Trump was elected. The market's been marked up on fresh air by the market makers. Now the range of this bar is actually less from low to high than this bar, and yet the volume is 10 times more. So again, we can see that if this was all buying this price bar based upon the range of this bar and the amount of energy, it should be a massive bar to the upside. So again, it confirms that the pros are selling. Also, 1 week into January, you can see the volume is still greater than the whole of November, and yet the range is sideways. So something is going on in this market. Now, will the market crash? I don't know that. But one thing I do know, there is a major correction coming in this market. And I'm going to move on to part 3 to give you the final piece in the jigsaw as to why I think this is going to be the case. So in part 3, we're going to be looking at implied volatility. What is implied volatility? Well, a quick overview is that options traders and derivatives traders have a way of measuring risk in the market, and for the options traders this is with the use of implied volatility. Now the relationship, I'm just going to move forward here and then I'll explain. It's pretty easy to explain with the chart. This is a 10-year chart here, and you can see that we've got the stock market in black. This is the Dow Jones again, and then in the red line here is a measurement of risk in the market. Now this is again very simple to understand. There is an inverse relationship between risk and a market falling, which you can see there. This is the 2007 banking crisis, also known as the Great Recession. Now you can see where the market fell out of bed, and the risk obviously increased for the options traders. You know, the greater the downside risk in the stock market, the more expensive something is. So you can look at this red line as cheap and expensive, and if it's exactly the same as insurance. If you live in an area where there are more burglaries or whatever, then the premium's loaded. If you've had more accidents, it's loaded, etc. So everything is down to an implied risk, and this is what we're seeing. But back in 1994, I uncovered something with implied volatility which is very interesting, and that's when we get down to the 12% area, which is down here. We always get a big market correction, or a correction of some sort. So between 12 and 10% or below, then we get a market correction. And you can see all of the corrections and the spikes here where the markets pull back on each occasion. And then the second thing with this volatility is when you get a 100% increase in the volatility, the market stops and then it continues its journey. But I'm not going to go into all of that. What I want to, in this particular case, we're going to concentrate on the low side of things and what actually happens. So this is the 10-year implied volatility chart. And I created these recently so I could actually have the price bars in the background and overlay the actual risk. So this is the big picture over the last 10 years, and you can see exactly what happened when we had the toxic mortgages banking crisis. You can see there, you get these spikes, the market rallies back, the risk drops, market rallies, and so on and so forth. But let's have a look at this in a bit more detail and then bring up to current day of what's actually going on. So this is a 2-year chart. This is when we had the Dow losing 1,000 points in one session last, not last August 2015. But prior to this, again, you can see we're below the 15, we're down in the 12 area. And when we get down into this area, you can see all of these small corrections in the market. And all of these are 500-600 point drops until we got this major drop here. The volatility doubled, more than doubled on this occasion. The market stops, they bring the market back. Again, we get back down to this area. You can see the market's being held, and then it drops. We get a double in value of the options implied volatility. We get a double bottom in prices, the market moves higher. Again, there we're back down below the 12, the market comes back, and so on and so forth. So let's move to the next. We've got a 1-year chart. We can see what's happened during 2016 here. This is Yellen increase in interest rates last year. You get this massive spike in the implied volatility. Once it's doubled from 13 to 24, it's at more or less 90% to 100%. Again, you get the double bottom here. The market then comes back, and the risk goes out of the market. You can see the risk moving there. We then get to the Brexit vote, and this again doubles in value. Market sideways. We then, we're getting into the election season. We're down at 891, and then we see then Trump get in. The market crashes 900 points, then comes immediately back, and then as it's moved higher, you can see we now got this sideways move that I've spoken about in the chart that we looked at, and we're down at 9.76996 for yesterday. Now, given the last week has been very interesting, actually, let me just move on to this chart here. This is the 6-month chart. In fact, I'm just going to go to a 3-month chart because this will be clearer. This week, which are the last 5 bars here, you can see the volatility has been dropping, even though the market has had days when prices have actually dropped. But you can see how the prices are being brought back by the green bars or coming off the lows of these candlesticks here as well. So for the last few weeks, even though apart from the one spike that we had here, the trend for the implied volatility is to the downside. Now, this obviously doesn't make any sense if you think that the pros are selling options cheaply in the event that they know that the market is likely to correct. Well, they know that to be the case as well. Actually, they're probably bigger buyers of this than actually sellers, and if they're sellers, they're going to hedge it. They're not stupid. They've done this for years. So even though the volatility is low, they know that they can hedge and still win on this deal. So that's how they actually do it. Now, this has never failed. There's 10 years of historical data here when the market gets to these lows. And what superseded this now and tends to be more in the mainstream business news is the VIX indicator, and that is showing the same thing as well, the volatility index, which is a tradable index. But because this was something I uncovered way back in 1994, it's something that I've always kept. And over the last few weeks, I've managed to actually put this into my own charts using a spreadsheet. And I can see the nuances and how this has actually worked during the last 23 years. So that's it. This is sort of my case for it laid out. We've got the fundamentals that obviously Trump is despised. We've then got the distribution in the stock market. I'll just flick back to that so you can see. And then again, if you use a weekly chart with real volume, not tick volume, it's no good looking at this in an MT4 platform with your online broker platform or anything. This is direct from the New York Stock Exchange. I pay for this monthly. It's a 1-day data download. It's in an old piece of software I developed in 1994, and it highlights these principles that are not even spoken of today because everybody wants everything instant in a 5-minute chart and all the rest of it. But when you step back, this is where the big money is made. You see the fundamentals and how the market works in action. And again, if you look at the daily chart, you'll see that same thing there that we've got with this holding the market whilst they offload. And then finally, of course, we've got the volatility, which we've just looked at. And if I can bring that back, there you go. We've got the implied volatility going back all the way through to 10 years, where you can see this principle of when we get below 12% in the implied volatility, the market makes a correction, and some big corrections as well. Big correction there obviously in 2008, but along the way we've got several thousand point moves here, a couple of thousand points. Big move here as well, 2,000 points, back then another 1,000 points before the market moves back again in the longer term. So very interesting picture there. Right, that's it for this video. Please feel free to share and get this out, and also any comments you have, then please list them below, and I will do my best to answer those as well. Right, that's it. Thanks for watching, and see you in the next one.